A warm welcome to all, and thank you for joining us for yet another insightful webinar from ICICI Bank. I hope you and your loved ones are staying safe. I am Anis Ali, and I will be your host today. Today, we shall be talking about a topic that influences our future investment decisions. And for that, we will try to decode the union budget and understand the impact that it creates in our day-to-day life. To share his thoughts and insights on this complex subject, it is our pleasure to have with us today Mr. Pankaj Pandey, who heads the retail research at ICICI Direct and has been with ICICI Securities for the past 20 years. Under his leadership, the ICICI Direct research team tracks over 100 companies across 16 sectors in the large, mid-cap, small-cap, and micro-cap universe. He also leads the technical and derivatives desk. So with this brief introduction, I will now request Mr. Pankaj to take over. Over to you, Pankaj, sir.
Thank you, Anish. Warm welcome to all to this session. Last few days have been very eventful for the market. We had two important events. One is Union Budget 2026-27. And then I think the much awaited trade deal with US got announced. And I'll be sort of covering a bit of both of them. Now coming to Union Budget, so Union Budget continues to follow the time-tested template of capital expenditure while guiding for the fiscal prudence. And I think the way we have seen focus on infrastructure, this budget also continues to sort of focus solely on infrastructure. But at the same time, what we are also clearly seeing this point of time is that now the focus is also on new emerging sectors like data center, healthcare, rare earth minerals. So, and on top of it, we have a pretty stable tax regime. So overall sense is that the budget is laying a foundation for a long-term sort of a structural growth. I'll come to the specific segments or maths of the budget. So from an overall growth perspective, the budget pencils in a nominal GDP growth rate of 10% odd. So which is again a very conservative kind of a number. And when we sort of look at some of the other factors, so for example, direct taxes are expected to grow at 11.4 odd %, whereas indirect taxes are expected to sort of grow or are expected to sort of taper off to single digits. Then I think no major policy announcements with respect to major tax changes. A lot of changes with related to direct and indirect taxes have already sort of happened. And I think the overall focus on road, railways, which have been the core of the capex, continues to sort of remain there. And I think from the budget perspective, this budget definitely is not a populist. So one point is when we look at the subsidy allocation, which is under the heads of fertilizer, food, and petroleum. So these are the three major heads. We used to do a overall spend of about 1.2 odd % of the GDP. Now in this budget or in this proposed budget for FY27, this number is expected to sort of come down to 1%. And I think the highlight of the budget is the government or budget proposing a tax holiday for foreign cloud centers, foreign cloud companies using data center infrastructure in India. And it can be a massive opportunity which can unfold going forward. So again, some of the key highlights, if I have to sort of put it in a single slide, one obviously is that the capital expenditure for FY27 is pegged at about 12.2 lakh crore. So it's a growth of about 11.5%. The capital expenditure as a percentage to GDP is maintained at 3%. And the overall capex, if you sort of notice in the last 5 years, is growing at about 19 odd percent. So which again is a pretty healthy growth rate. Now, defense was expected to sort of witness a higher allocation, and on expected lines, we have seen defense allocation going up by 17.6 odd percent. A road, which is one of the highest segment, has got an allocation of 8% and railway about 10 odd percent. Road and railway combined is about 50% of the overall capital expenditure. Uh, this government has been very particular about maintaining a fiscal glide path, and so FY24, FY26, the fiscal deficit is expected to be met at 4.4 on stated lines. Next year, it is expected to come down by 4.3 odd percent. Now, the government is shifting this fiscal deficit template to debt to GDP ratio. So that number is expected to come down to 55.6 odd percent. And then I think I'll highlight upon the buyback, which has been made investor friendly, and bit on the data center ecosystem, which has got a big boost. And like I said, no major changes in the personal and the corporate taxation structure. Now, coming to the broader math, like I said, nominal GDP growth rate is expected to grow by 10 odd percent to 393 lakh crore, and which again is a very conservative number. Because if you, we had this RBI policy yesterday, so RBI is expecting inflation in the first half of next financial year to go somewhere about 6 odd percent. Largely, the consensus expectation for GDP growth rate is around 7 or 7% plus. So 11% kind of a nominal GDP growth rate is pretty much on expected lines. And with US-India tariff deal done, you could potentially see further improvement also. So budget taking a 10% kind of a nominal GDP growth rate is pretty conservative. Overall, the fiscal deficit is maintained from an absolute number perspective at about 17.2 lakh crore. So this is slightly higher than the market expectation. But overall, the number-wise, the number looks pretty good. What you see in terms of indirect tax revenues is, especially when you look at a segment like GST revenues are expected to sort of decline by 2.6 odd percent. We all know that some months back in the month of September, the government had rationalized the GST rates for a lot of consumption categories. So obviously it has got its share of impact in terms of lower collection. But I think the focus of the government is also a lot on non-tax revenues. So RBI dividend is one of the highest, which we are going to see. It's already crossed 3 lakh crore, and even next year it is going to be even a lot more higher. So sum total from a budget math perspective, the numbers are pretty conservative. We don't see much of a challenge in terms of government not being able to achieve most of these numbers. Now, like I said, the government has been following a time-tested template of capital expenditure-led allocation. So when we look at the overall allocation, so 11.2 lakh crore was the expectation, was the budget number for FY26. Now, the revised number, obviously, there is some lower capex in certain pockets, so which is why the revised number is 10.95 lakh crore. And on top of it, we are seeing a growth of about 11.5%, so about 12.2 lakh crores. And this year, one of the factors also have been the lower sort of inflation, which we have seen. But sum total, the overall capex has been growing in pretty healthy growth of about 17% in the last 5 years. And segments like road or railways have seen a very high teen kind of a growth. Defense of late has started to sort of pick up. And while the government is pretty gung-ho on the overall capex side. They've announced seven high-speed rail networks. Our sense is that when we sort of execute these, the opportunity size could be somewhere about 7 lakh crores. Some total government has maintained that they'll continue to spend about 3% of the GDP on capital expenditure, which is what has been maintained even in this budget. So no surprises here. Then I think subsidy is something a lot of people are worried because you're sort of throwing a lot of or you're undertaking a lot of non-recurring expenditure, which is not really productive in future. So food, fertilizer, and petroleum are the three major categories where we see the subsidy allocation being higher. Fertilizer has been a sort of a known devil for a long period of time. Just to give a highlight, we sell urea somewhere about at 5.6 rupees a kg, whereas the actual cost is in the range of say 40 rupees a kg plus, and which is why we continue to see a good amount of subsidy on the fertilizer. Since the crude oil prices have been sort of maintained or petroleum product prices have been sort of stable, so which is why the expectation of fertilizer subsidy at 1.7 lakh crore looks reasonable. Food is fine because we are distributing food grains to farmers, so that also number is maintained. Since petroleum product prices are down, so except for LPG, there is no subsidy burden. So overall subsidy burden is coming down to 1%. Then I think there are other schemes like, say, for example, the allocation for uh, 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 the erstwhile name of MG Narega or Mahatma Gandhi Narega scheme. So that has seen a slightly higher allocation of 1.25 lakh crore from 88,000. But there is a logic for it now. The government or the central government wants state government to sort of participate in the scheme by contributing 40%. So of this amount, about 30,000 odd crore is for the continuation or so that there are no disruptions in the scheme when this transfer actually happens. Otherwise, overall sense is that while you might continue to sort of spend better, but with both state plus center contributing to this scheme, the implementation is expected to be a lot more better. Otherwise, we have seen cases where a person above the age of 80 is also being sort of described as working or getting benefits because of this. Then there is a PM Kisan Nidhi Yojana, which the allocation has been maintained. On the divestment side, the government is going to miss the divestment number from 47,000 odd crores to it will come down to 34,000 odd crores. But for next year, the number is pitched higher at 80,000 odd crores. And our sense is there are two major things which is going to drive this number. One, we all know that the government is in its final leg of selling 30.5% stake it holds in IDBI Bank. And our sense is that it could easily fetch government about 30 to 34,000 odd crores. Then the government continues to hold good amount of shares in LIC. So as a part of listing rules, they need to sort of trim down their stakes. So this year, it is possible that the government might come up with an FPO and might raise 15 to 20,000 odd crores. So I think that is where this 80,000 number looks believable. The other is the RBI continuing to pay more than 3 lakh crore to kind of a dividend to government. And I think as long as your US interest rates continue to remain at elevated levels, our sense is that this 3 lakh number may not be a big challenge for RBI to pay in terms of dividend. So budget math looks pretty positive. On the specific to defense, so one, we have seen allocation going up, say in the aircraft and aero engines, say from 48,600 odd crores to 72,000 odd crores. And our sense is that what is keeping this number higher even this year is two things. One, the government is looking to sort of give 15,000 odd crore allocation for probably AMCA fighter to be sort of developed, and we have got three companies there. Then the other is that the French president is expected to visit, so probably Rafale agreement could sort of get signed. So probably that amount can be there. So that is one of the numbers which looks slightly higher. So which is why our sense is that these are one of the two, or these could be the reason, which is why we have. Otherwise, most of the numbers are stable. Our sense is that even on the Navy side, next year you will see probably the Maslow doc doing a deal with the German government. So with that in perspective, the project 75I might sort of get kicked in. So defense is clearly a beneficiary. Now, like I said, there are a number of new segments or sectors which the government has identified and allocation has been given. And these are broader 7 sectors. One is the biopharma Shakti. So there is an outlay of about 10,000 odd crore. Then, while the project semiconductor mission carried an outlay of 76,000 odd crore, the government is going to launch India Semiconductor Mission 2.0. So, which is going to further enhance. Then electronic component scheme is getting a good response. So there the allocation has gone up to about 40,000 odd crores from 22,000 odd crores. Then there is a focus on rare earth minerals, given the fact that China has been dominating the entire value chain. Then there is a good amount of focus on setting up dedicated chemical parks. And then even for within the capital goods for high-tech tool rooms establishment, there are measures for it. Similarly, for construction machineries or tunnel boring machines, there is a scheme for it. Then I think the government wants to manufacture a lot of containers which are required for shipping lines. So that is where, and I think labor-intensive textile sector is also sort of mentioned or is being mentioned. So these are some of the areas. Now, like I said, one of the biggest announcement is the tax holiday to sort of anchor data center capacity creation. Now, currently our capacity is somewhere about 1,331 or 1.3 gigawatts, which is expected to go up to about 5 to 8 gigawatts. Currently, we have overall about $70 billion kind of a commitment from big majors or big hyperscalers like Microsoft, Amazon, Google in India. And there is a sense that this number going forward can go up to about $200 billion, because what you're doing is that you are offering a 20-year tax holiday to foreign cloud companies if they're using the data infrastructure. So they can sort of sell cloud services through Indian resellers, and they can sort of offer cloud services to global companies. See, India also benefits from the advantage it carries because of the good solar radiation. And our sense is that while we are sort of doing very well in terms of power generation capacity, especially on the renewable side, which again is wind plus solar, I think what is also clearly sort of coming out is two things. One, the government is clearly focusing on nuclear power also, and our sense is that nuclear power will be carrying the base load or will be anchoring the base load for data center from a power perspective, and which is where a lot of technology tie-ups plus fuel types are required. I think this is an opportunity itself, which will require a capex of nearly 20 lakh crores. And this will also require massive amount of financing. So which is why the FM spoke about merging PFC and REC, and also creating or adding a few more government-owned entities, eventually making it a pretty big NBFCs. I think after a long period of time, we are hearing FM talking about NBFC. So our sense is that this is one area which has got the maximum focus. And on top of it, you have given a tax holiday until 2047. So which again is, so it is going to benefit a lot of sectors, right from real estate, because real estate is also a good requirement for this, which is why the government wants PSUs to recycle their real estate through REITs. Then power equipment is definitely required, cooling infrastructure, and then a lot of other activities on network infrastructures are required. So this is going to sort of anchor a new set of a segment overall, right from power, real estate to IT. And this is also going to sort of enhance the overall picture of Indian IT companies, because up till now, Indian IT services were considered to be laggard in terms of AI. Now you need data centers for AI. So from that perspective, this is one of the biggest announcement. On the pharma side, the government spoke about biologics and biosimilar. I think this is happening for the first time. Our sense is that next 10 years, there is a $250 billion worth of drugs going off patent, and the biologics drug going off patent. So India can manufacture a similar biologics, or which is called biosimilars, and which is why government is focusing on having about 1,000 accredited Indian clinical trials. So that is the announcement. Then on the power and capital goods, a lot of duty exemptions have been given, because you would want to create a pretty massive data center capacity so for that you require good amount of power plus capital goods. So which is why I think whatever is required to sort of power, or to sort of as a catalyst for that, government has given exemptions. Then real estate is another beneficiary. I think the government spoke about recycling of real estate of CPSEs. So that is another thing. The one more thing, we had RBI policy yesterday. What got announced is that uh, banks will be allowed to sort of lend money to REITs. So while details are still sort of awaited, but what I'm sort of sensing is most of the policy announcements are directed towards that. Then metal and mining, government clearly spoke about factors like carbon capture scheme, because if you have to export to Europe, you need to produce a lot of green steel, which is why you need to sort of do that carbon capture. Which is why there is an outlay of 20,000 odd crores. Jan Jeevan Mission, the overall allocation had come down in FY26 to 17,000 odd crores, because I think a lot of corruption cases came out. And I think the government has now probably set the process right, and which is why the allocation this time is restored to somewhere about 7,000 odd crores. Auto, I think there is a PLI scheme going on for niche technologies and electric mobility. So that is one. And then there has been allocation, or there is a focus on rare earth mineral, which is going to help. And like I said, on the EMS, two things. One, the India Semiconductor Mission 2.0 is going to be launched. The existing electronic component manufacturing scheme, the allocation has been increased to somewhere about 40,000 odd crores. And I think one more thing what the government has done is on the IT side is that see, rules related to the safe harbor eligibility. So these rules have been increased from 300 to 2,000 odd crores. What happens is that if a GCC gets opened in the country, if it is providing IT services, the taxations are sort of different. If it is R&D services, they are different. So what the government is saying that let's have a safe harbor margin of 15.5% across services what you provide. And basis that the tax certainty or the dispute related to the kind of services what they provide, and correspondingly the taxation gets simplified. So I think which again is a positive for Indian or for companies which are going to set up bases in India. Then I think most of the things were positive. So there is a high-level committee on the banking. So government is looking to create 3 or 4 big banks. So SBI, for example, is a 45 lakh crore bank, kind of a size. A lot of PSUs are smaller. So don't be surprised if some month down the line we hear some consolidation there. The FM already spoke about NBFCs getting created, so which is PFC and RSE are expected to be restructured. The only thing negative in the budget was the STT being hiked. So there was an expectation that since the last few months markets have not been doing well, so government might do something to arrest this FPI outflows by incentivizing something. But on the contrary, the government increased the STT on futures and options because government feels that a lot of retail investors are losing money. And that was not really taken well by the market. So that was the only thing which did not go down well with the market, and which is why we have seen that kind of a reaction on Sunday. Rest of it, I think the budget was pretty much structural from a growth perspective. Then I think there was a bit on the overall chemical space. Just a sec, I am slightly. Sorry, yeah. So there was a bit on the overall logistics as a space. So there also the government spoke about container manufacturing, and then new dedicated freight corridors is what they've announced. One more interesting thing here was the change in the buyback regulation, because what has happened is that if a company announces a buyback, now those were treated as a dividend, and whichever tax bracket the eventual person used to sort of get dividend, that was the taxation which was there. Now those will be taxed either in terms of long-term gains or short-term gains, depending on the extent of holding, and which is why this is a positive change. Definitely will help companies where the prices have declined. The companies are sitting on cash. And even for corporate promoters or non-corporate, their taxation will come down to 22% to 30 odd percent from a lot more higher levels earlier. So buyback has been made pretty positive. So this was all about budget. So budget is again focusing more on the structural growth story. So no major challenges we see from an overall perspective. Now, I've got a bit on the US-India trade deal. A lot of it is needs to be announced or needs to come by. But what we have is that the tariff rate on India is expected to come down from 50% to 80 odd percent. And this was the much awaited announcement after a long period of time. And when we look at the competing geographies, so we are at a pretty much favorable position there. Now, beneficiaries, according to me, the biggest is the textile one, because when we look at US is a $100 billion kind of a market. India has got 8% market share. So about $8 billion is what probably we export. Numbers, I'm talking of very broad numbers. Whereas when you look at EU is a $200 billion kind of a market, and we have a share of under 3%. So it is very much possible that we can increase the share there. Textile is expected to be a lot more beneficial. So while yes, the traditional market like US will get revived, you have newer opportunities coming up in terms of EU. I think on the auto side, while CV segment does not get impacted because CV, there is a separate tariff category for all the countries. I think on the overall sense is that it is more beneficial for the auto ancillary companies which are catering to the CV segment. So that is the benefit. EMS players will sort of benefit in terms of higher or at least the deal wins could be a lot more better. Capital goods again is one segment which was impacted that should benefit. On the chemical side, we've seen a lot of dumping by China, and relative to China now, at least we are at a slight advantage in terms of the relative percentage of tariff, which means that the pricing for India can become better, and also the fact that going forward, this segment can sort of get revived. And mind you, budget also had some incentive for this sector. I think that's all I have from the overall perspective. Our sense is that in the last 7, 8 odd days, announcement within the budget and also with respect to the trade policy has been pretty significant development for the market. So US tariff deal is extremely important from a sentiment perspective. So we feel that large caps will benefit from because of large inflows, small caps because of improved sentiment. And what budget does is that while it is anchoring growth through the existing traditional sectors, now the focus is shifted to emerging sectors like data centers, biosimilars. So that way, I think budget is sort of shaping up the overall economy for a structural, sustained growth. That's all I have to say. Thank you so much. I'll be more than happy to take questions.
Great. Pankaj sir, thank you very much for this insightful presentation. I'm sure that this initiative provides numerous opportunities for our NRIs to gain a comprehensive understanding of India's economic growth story. So now with this, we will move to our Q&A session. While you have covered most of the points, but there are certain recurring questions to this. I will just start with the first question, which is what are the key union budget announcements that directly impact NRIs this year?
So, Anish, there are some of the things are so while yes, when we look at the broad budget, we haven't seen major announcements happening on the direct or indirect taxation side. But yes, there are some announcements which will definitely have implications for NRIs. So one, my sense is that there is a ease of compliance for NRIs. Then there are voluntary asset disclosures which are there. Then litigations are expected to be lower. Then there is a decriminalization of technical defaults. Just to sort of highlight, for example, in case of a property transaction involving non-resident. So, for example, if a non-resident is willing to sell a property located in India, earlier, if a buyer is a resident Indian, they need to sort of obtain, say, for example, tax deduction and collection number to deduct the TDS, and even the TDS rates were higher. Now, what the budget is now doing is that instead of now TDS, the entire instead of the stand number being sort of procured, the TDS can be facilitated through PAN, so through which you can sort of generate challans. So life becomes a lot more easier if they have to sell a property in India, and this is going to be effective from 1st October 2026. And there are other measures like, for example, there are measures related to foreign asset disclosure. Then there is an extension of timeline for revisiting ITRs. So earlier, a time limit for ITR returns. I think this was 31st December. Now this is extended to 31st March. Then revision is also allowed, I think, after December, unless you sort of pay a nominal kind of a fee. Then NRIs can file. So from what is I think important is again on the updated return. So which we believe is a sort of a game changer for NRIs. So now NRIs can file updated income tax returns after reassessment also. So I think the additional tax of 10% will apply. But now the updated return becomes binding for further proceedings. So I think that is a sort of these are some of the key features which is coming to the top of my mind.
Interesting. So, like you said, if selling becomes easy, buying becomes even more easier. So, yeah, that really works out well. So the next question. Yeah, sorry. Sorry, I just got disconnected. So the next question, Pankaj sir, was, have there been any changes in NRI taxation, especially on income earned or invested in India?
So my sense is that with respect to taxation, no major changes sort of happened. But like I said, a lot of procedural changes are there. One time limit for ITR return has been sort of changed from say 31st December to 31st March. Then there is a procedure for staggered ITR due dates introduced. So for individuals, ITR 1, ITR 2, you could have, I think that they can do the filing till 31st of July. I spoke about updated returns. So now they can file revisions after the reassessment or process also begins. So by paying 10% odd. Then I think what is also happening is that see, a lot of these measures will help NRIs in terms of putting on record missed foreign income reporting, unexpected capital gain tax gains if they are carrying, or if there are errors in the residential status. So I think so from that perspective, these are some of the procedural changes, what I would say, rather than on the absolute taxation front. That is what I recollect as of now.
Okay, got it. Got it. So the third question is, does the budget signal any long-term policy direction that NRIs should factor into their Indian investment strategy?
So I think one of the announcement related or was there in the budget related to the overall investment, which could sort of shape up the investment strategy, is that when we look at under existing rules, individual NRIs or overseas citizens of India, they can invest or they can participate in any company by to the tune of about 5% and group of NRIs can sort of participate up to the tune of 24%. So I think this limit has been increased from 5% to 10%, which again means that structurally government wants them to be sort of pretty much long-term investors. So from that perspective, I think that is one of the key positives. Similarly, like I spoke about, if they have to sell their property in India, a lot of issues were there, which is now being sort of simplified. So our sense is that if I look at the budget, the government did not really give in to the pressure or give in to the market pressure of giving some tax relief to FPIs, foreign portfolio investors. Instead, what they've given is a tax holiday for data centers. So I think the preference is clear that they would want the long-term stable money to sort of come into India compared to a short-term money. And something similar for NRIs, I think. So they are looking at pretty long-term engagement with NRIs. So from that perspective, whatever procedural changes have happened, I think are a step in that direction.
Okay, got it. Uh, so the next question, it is, what immediate actions, if any, should NRIs take to stay compliant and tax efficient post-budget?
So I think four, five things. One, to sort of stay compliant and become tax efficient. I think the government has done four, five things. One, they have staggered the ITR due dates for I think for individuals, which is 31st July, for non-audible businesses or trust, this is up to 31st August. Then there is on the updated returns, they can file updated returns with an additional 10%. And then I think overall, even there is an extension in timeline for this thing. So I think these are the measures which have been there, which is the government has taken. So from that perspective, these are the measures which is what NRIs can sort of incorporate to become tax compliant.
Okay. Okay. So the practical uses, like, those DTA, AA, and all of that is what they can avail.
Yes.
Okay. How does the budget address repatriation rules or limits for NRIs and overseas investors?
So I spoke about that, Anisha. So, for example, if NRIs are looking to sort of invest earlier in individual NRI or overseas citizen of India, probably can invest at 5% of in a company's paid up equity capital. Now that limit has been raised to about 10% for a group of investors. This is now about 24% with a special board resolution. So that way, I think these are some of the measures which the government has taken from an investment perspective.
Okay. So the next question is, What sectors or asset classes look most attractive for NRI investments after the budget announcements?
So Anish, if I sort of look at it, there are clearly 4, 5 sectors which are going to benefit. One, I think the entire data center ecosystem is going to sort of do well. So it
Right.
will have a positive rub-off on technology as a sector because Indian technology is considered as a laggard. And with data center capacity coming in, see, we consume about 3% of we consume somewhere about 23% of the overall data, but we have a data center capacity of about 3 odd percent. So there is a clear anomaly. And for more AI related models, a good amount of data center capacity is required. So Indian IT companies can sort of change that image of being laggard going forward. We have already seen companies announcing capex there. Then I think for that to happen, you need real estate. So which is why real estate is one of a significantly beaten down sector. There are measures for which NRIs can also take in case if they have property to sort of sell in India. Real estate as a sector looks good, and it's a massive sector because if real estate does well, a lot of ancillary sectors like cement, steel, uh, the entire consumer durables as a pack, autos, a lot of these sectors also sort of do well. Then I think power is another sector which is expected to be the sector of the future. One, you are looking to sort of improve the traditional sector by reducing the losses. I think after many years, the distribution companies are making marginal profits. That's a welcome change I've seen the last 4, 5 years. Then the government is pretty serious on the nuclear policy, and our sense is that while budget is announcing a lot of tariff-related relief, we could be doing a lot more other deals with respect to technology from US, with respect to fuel from Canada. So nuclear power is one of the big sectors which can happen. And I think then associated sectors. So beside that, I think road, railways, or these are. And to fund all of this, BFSI is another sector which is looking pretty good. So I think these are the sectors which the budget is clearly focusing on and which are expected to be clear beneficiaries of the budget announcement as well.
Great, sir. Great. Sir, before I take the last two questions for today's session, I will request all my viewers to, take a minute and fill a feedback form, which will now appear on their screens, so that, it will help us in giving us more insightful and relevant sessions for our customers. So while they do that, just give me a minute. And the last, I'll take just two questions now. So, how does the increased STT affect your brokerage charges? How effective will the new infrastructure risk guarantee fund will be attracting sticky NRI FPI capital into greenfield projects? And does this reduce the historical construction risk premium we usually witness in Indian infra?
So I think, Anish, clearly the government focuses on channelizing money into the markets for long-term funding, both in the debt and equity side. Now, futures and option, when we look at the overall allocation, the government is looking to generate from an additional 10,000 odd crores. So from about 67 or 60. 7,000 odd crores to 77,000 odd crores. So revenue generation is definitely not the criteria when we are increasing the STT rates. The point is again, a lot of customers make losses in futures and options, and government does not want to sort of do that. So which is why you will have impact, especially because in F&O market, you have various segments like high speed trading, you have algo trading. A lot of these segments, or in general, if you're buying call and put options, the overall STT rates going up on both futures and options obviously would mean that your returns are going to be lesser there. And that is the sole purpose of bringing this up. On the infrastructure side, clearly I see signs that the government is, so for example, when we look at infra REITs, the banks can sort of now fund it. With yesterday's RBI policy, one clear announcement is that the banks can now fund real estate REITs as well. Because if you have to create a data center capacity, for example, you need land and you need funding for it. The funding banks are typically not required to fund for real estate. That is not sort of allowed now, but for REITs, they can fund. So you're sort of channelizing a lot of long-term money there. And I think the other structural aspect is that if you're keeping fiscal deficit under tight control compared to a lot of other segments or sectors or countries, which clearly means that you are looking at sustaining economic growth. So, for example, our deficit is 17 lakh crore. Where on the capex side, we are spending about 12.2 lakh crores. I think in some ways, some years down the line, our deficit and fiscal deficit number probably could be inching very close, which clearly means that you're borrowing only for a good structural capex. So, which means that overall sense is that if you are taking those kind of fiscal measures, clearly there is a focus on the infrastructure as a segment side, and which I think is has been the hallmark of this government.
Okay, great. So we'll take the last question for today. And that is, should funds be continued to be held in foreign currency like USD, or should they be progressively converted to INR and invested in India? What's your take, sir?
So, bit tricky to answer given the fact that we see a lot of volatility, but our sense is that most of the negatives which were impacting currency and foreign outflows have been addressed with US-India trade deal. Unless something different happens, our sense is that with 18% kind of a tariff, we are in a situation wherein the currency depreciation will not happen at the pace at which it has sort of seen. And so my sense is that there could be a technical appreciation in the currency because probably a lot of people might be holding currencies outside and thinking that let the currency depreciate and then they might sort of bring that money to India. Probably that tide is sort of turning. We have already seen some signs of currency appreciation post deal announcement. The FPI flows in the market have definitely receded. We have started seeing FPIs turning buyers. And our sense is that things will get better even in the second half because this year, earning growth was in single digits. Next year, earning growth is expected to accelerate into double digits. Last 15 months market have not done so much, so rich multiples are also sort of taken care of with this kind of a time and price correction. So I think most of the negatives of Indian markets and Indian economy is getting or is taken out. So I don't think this is a time to sort of bet against the currency. Not to say that it can't be volatile, but largely my sense is that if you are sitting or if you're keeping money outside, probably some money can be brought in at current levels. I don't see. I probably see a scenario of some bit more of a rupee appreciation.
Fantastic. Thank you, sir. Thank you for this insightful session and answering our questions. So with this, we come to the end of today's session. As I mentioned earlier, we will be bringing more high-impact sessions on multiple topics in subsequent months. Thank you very much for being with us today, and we look forward to seeing you again in the next webinar. Till then, stay safe, bank on us. Thank you.
Thank you so much.